Home insurance could be the next economic crisis, and it's extremely important that we talk about it. We can't talk about building more homes without talking about how we're planning to insure them. We also have to talk about the risk model that is the American dream and having home ownership be a big part of that, because in the future it might not be able to.
Some South Florida condo owners are being hit with six-figure assessments that are forcing them to flee.
Insurance companies say there's just too much fire risk to auto-renew everyone's policy.
People around the Bay and across the state are now being told their homeowner insurance policies will not be renewed.
Insurers are fired up about California regulations, and they're right.
But Allstate, who insured Darlene's house for 18 years, recently sent her a non-renewal notice.
Talking about people not getting homeowners insurance, this sounds so risky.
It sounds like such a bad idea.
I finally escaped the garage, and I'm here with my books on the ground, and I'm going to talk about home insurance and how important it is in this video today. I'm first going to talk about the economic proposals that Kamala Harris proposed. She released a variety of economic proposals to a variety of pushback and support. For both candidates right now, it's all about sentiment and messaging, the vibes, some might say. But Kamala Harris also announced some policies around housing, including the construction of 3 million new housing units over 4 years, up to $25,000 in down payment support for first-time home buyers, a $10,000 tax credit for first-time home buyers, tax incentives for builders that build starter homes sold to first-time buyers and for building affordable rental housing, a new $40 billion innovation fund to spur innovative housing construction, repurposing some federal land for affordable housing, a ban on algorithm-driven price-setting tools for landlords to set rents, removing tax benefits for investors who buy large numbers of single-family rental homes. Only 2 of those proposals are demand-centric, 2 and 3. 1 responds to constituents' concerns, 8, and the rest focuses on supply. I've written a lot about housing and have done a series of interviews on housing, most recently with Jared Bernstein, chair of the Council of Economic Advisors, and Dana Hornung, deputy director of the National Economic Council. And of course, I've done 2 interviews with Wally Adeyemo, the deputy secretary of the Treasury. You can see all of those videos on this YouTube channel, as well as the podcast and Substack. Supply is the biggest issue that we're facing, but you kind of have to have some demand side support as well. And part of that is because of the pencil out problem. As Jared Bernstein describes, even if you build housing, it doesn't mean that people can afford it right away. And the goal is for people to afford it right away. So with all this being said, everything that we know about housing, it should be all about building more of it, right? No. And of course, housing is important for many reasons. This is clearly outlined in the 2021 Works in Progress article, Housing Theory of Everything. They write, try listing every problem the Western world has at the moment. Along with COVID, you might include slow growth, climate change, poor health, financial instability, economic inequality, and falling fertility. These longer-term trends contribute to a sense of malaise that many of us feel about our societies. They may seem loosely related, but there's one big thing that makes all of them worse. That thing is a shortage of housing. Too few homes being built where people want to live. And if we fix those shortages, we will help to solve many of the other seemingly unrelated problems that we face as well. Many of the problems that we face as a society are exacerbated by the fact that we just don't have enough homes. The loneliness crisis, demographic crisis, wealth inequality, and subsequent regional inequality, the health issues, productivity, innovation, all of our issues are rooted in housing just being a little bit too expensive. Housing is complex. As Derek Thompson has highlighted, it's meant to be both a speculative asset and a place to live. Something that is your entire retirement fund and then also a place to raise your kids. It's just those 2 things can't reconcile all the time. And it's exacerbated by this thing that I talk about all the time, the fact that the bottom 50% have all of their wealth tied up into homes. If you look at this graph from the distribution of financial assets from the Federal Reserve, you can see how intense this problem is. The top 10% of Americans have all their wealth in business ownership and equities, but the bottom 50%, it's all in real estate. One could argue that the reason that we've had such negative consumer sentiment over the past few years is because of the structural affordability that prevents home ownership. Look at this chart. This is a chart of the millennials who've become very, very rich because they entered the housing market at the right time. And then look at those who didn't enter the housing market at the right time. We need 1.6 million homes to meet population growth, and we are nowhere near that. But it's tough to simply say build more, and on the supply side, they're trying to build more homes, but it's not quite happening. There are severe supply-side constraints with sawmill capacity, as Joe Wasenthal of Bloomberg has written about. You can liberalize zoning, you can cut red tape, and you can subsidize demand and so forth. And some of that might help, but at least in the here and now, market conditions are starting to aggravate any future efforts to just expand supply. And the other reason that it's just tough to build more is home insurance, which we need to consider in any conversation that we have about building more housing. So what is the insurance market? As Spencer Glendon and Barney Schwabel wrote, it's important to understand what insurance isn't. It is not protection against hazards like flooding, wind, fire, and hail. It's a financial contract to reimburse property owners for the cost of repairing structures only after events that are particularly rare. If hazards stop being rare, stop being predictable, and or produce damages that aren't easily repairable or suggest that a building should not be rebuilt in that location, the existing market structures for both property insurance and property more broadly won't work. It's not about protection. It's a financial contract that relies on assumed stability. As the authors highlight, virtually all property insurance is annual. There is no term structure. After a claim, the insured is expected to rebuild the same building in the same place. Insurance is only available for damages to a structure, not to the value of the land. Regulators often insist on using backward-looking data, prohibiting the use of climate models and climate-aware catastrophe models. Regulators also regularly limit the amount by which insurance rates can rise year to year, which is a massive problem. And this gets into the underpricing of risk. A 30-year mortgage doesn't require a 30-year insurance policy. The insurance just renews every year. But the weather is rapidly changing every year. The risk is rapidly changing every year. So this is a problem of assumed stability. It also means the home, if something does happen, is expected to be rebuilt in the same place, assumed stability, and insurance usually doesn't cover the value of the land. And most importantly, the data is backward looking, and forecasting is an art, not a science. Why are homes uninsurable? So what's happening? We had 28 disasters last year that caused more than $1 billion in damages. In the 1980s, that number was 3 disasters. Over 2.5 million people were pushed out of their homes last year due to storms and fires. And even if you normalize these numbers for population growth, the US population has grown by almost 100 million people since the 1980s, from 226 million then to 334 million now. Doing the relevant math would result in 1.33 disasters per 100 million people in the 1980s, and 8.3 disasters per 100 million people in 2023. The US government has rebuilt some structures 4 times over the past 20 years at a huge cost. Fool me once, shame on you. Fool me 4 times, it's time to move to a different place, if you can. As the Washington Post reported, the 5 large US property insurers, including Allstate, American Family, Nationwide, Erie Insurance Group, and Berkshire Hathaway, have told regulators that extreme weather patterns caused by climate change have led them to stop writing coverages in some regions, exclude protections from various weather events, and raise monthly premiums and deductibles. Home insurers are telling regulators, hey listen, the options are no insurance, underinsurance, and more expensive insurance. So buckle up. The reason that home insurers are doing this is because they are losing a lot of money. US home insurers lost $15.2 billion last year, the most since 2000. Private insurance companies have to balance the risk that they're taking with hedges and plain vanilla investments. If the risk becomes too high, their business, they're going to stop writing policies. Florida, California, and Louisiana all have had home insurers simply leave the market. But the problem is people like those states. California is beautiful, it has a lot of problems. Florida is beautiful, it has a lot of problems. Louisiana, beautiful, a lot of problems. California, Florida, Georgia, North Carolina, Texas, and Washington accounted for 53% of the country's population growth between 2010 and 2020, and insurers don't want to be there. And if they're not there, you can't be there either. And of course, most homeowners didn't know that their homes would be uninsurable. If you read the interviews with those impacted, it's absolutely devastating. These are people that signed up for the American dream, and they're now facing the American nightmare. And the startling reality that it's not yours if it's not insured. Because you can't have a mortgage if you don't have home insurance. Insurance rates have increased by an average of 20% since the start of 2023. The average annual premium is $2,478, but it's over $5,000 in Oklahoma and Nebraska. The rates are accelerating too, meaning the problem is getting worse. Homeowners are paying 38% more for insurance than in 2019, with Arizona, Illinois, and Nebraska seeing over 55% hikes. The reason that rates have skyrocketed for homeowners is because repair costs are surging due to inflation. Structural replacement costs have been 55% of the insurance increase between 2020 and 2022, and that increase is due to the cost of construction materials. There are also issues with insurance fraud. Florida accounts for 9% of home insurance claims, but 79% of lawsuits over filed claims. This impacts the entire economy. You cannot get a mortgage if you don't have home insurance. You can still own a home, which is why we might see an increase in cash bought properties in disaster-prone areas. In January 2024, 32% of home sales were made with all cash, so they don't necessarily require insurance. But the 68% of people that still need mortgages absolutely require insurance by law. The real estate market certainly needs mortgages in order to keep on surviving. As Bloomberg wrote, banks don't make mortgage loans for uninsurable properties. Without those loans, the real estate market slows to a crawl, which in turn eats away at household wealth and the tax revenue that state and local governments rely on. This insurance problem is not just an insurance problem. This is an economic and financial crisis. There are so many dominoes in the insurance line, real estate, tax revenue, etc. The housing theory of everything applies here too. So why is this happening beyond climate change? So regulation. Part of the problem is that some state agencies regulate rate increases, meaning that many people pay much less than they should to insure their homes, underpricing of risk. We've never seen that before in financial markets. According to an example from Bloomberg, a California home that had a premium of $2,000 in 2010 was paying $4,820 by 2022. That's an increase of 7% a year or so because California heavily regulates insurance price increases. But this massively underprices the risk. It should be way closer to $8,000, meaning these people are paying $3,200-ish less than they should. This leads to disastrous results. 2 out of every 3 American homes are now underinsured. An estimate from First Street states that 39 million US homes are insured at artificially suppressed prices, and this also pushes the cost off to states that don't regulate insurance, as the New York Times reported. The article walks through the story of Enid, Oklahoma, the apparent riskiest place in the country to own a home, despite being far away from the ocean, having relatively low fire risk, and a very small population. In the US, homeowners pay an average of $500 in home insurance for every $100,000 in home value. In places like California, it's more like $50, but in places like Enid, it's more like $3,500. And when storms happen in tightly regulated places like California, guess who foots the bill? Enid, Oklahoma, because they don't have regulation. So insurers are like, we're going to raise rates in places that we can because we can't in California. So another problem is reinsurance. These are people who insure insurance companies. They're raising their rates because rates are really high right now. It's expensive to rent a balance sheet. Part of that, will go away because the Federal Reserve is going to cut rates in September. But the other part of it is the increased amount of small disasters. The reinsurers call these secondary perils, so not big disasters, but things like wildfires and flooding, which sound really big, but these are increasing. They've raised prices on property insurers by 37% in 2023. And then also part of the problem, somewhat ironically, as Lance Lambert of Resi Club has highlighted, is that we built. It is tough. Higher density in disaster-prone areas means more houses can be damaged, which means higher insurance. As Christopher Graham at Aon Best said, construction in catastrophe-prone areas adds to flood risk. It also increases the risk of wildfires in areas prone to them due to human activity, as well as utility companies. More humans, more risk. It impacts all types of housing too. Los Angeles affordable housing providers have seen their premiums jump 400 to 600% in 1 year. The biggest part of the problem is that insurance is a shared pool of risk, and there are a lot of spots in the country that just can't afford the risk anymore. When insurers leave an industry, the industry can no longer function. That's what happened to coal. 45 insurers left, and new coal-fired power declined by almost 90%, as Sierra Club wrote. It can also keep industries alive, like oil and gas, just as an example. What is happening in insurance is not just because of climate change. It's this mix of regulatory gaps, too much regulation in states like California and too little regulation in other states like Enid, and a double-layered cake of reinsurers and insurers, and a paradoxical twist. that if we build more homes, we need even more insurance than we thought. So what's next? It's either the path of the government or it's cash buyers. And a lot of people are like, oh my gosh, the government should just get out of insurance entirely. And it's like, hey buddy, like you can't have a home if you don't have insurance. And the government is the only party willing to backstop you. And so there's this thing called FAIR plans, which are fair access to insurance requirements, which are state mandated property insurance plans that cover people that can't get covered by the market. Citizens Property Insurance in Florida is already the second largest insurer in the state because nobody wants to insure anybody in Florida because of the risk there. Most of the state programs are not very comprehensive and they're quite expensive because they're designed to not compete with private insurers. So we'll have to see a reimagining of government backstops, and we'll also have to ask ourselves what we want the government to backstop. If you buy a house with cash, you can skirt the insurance requirement, but there's obvious risk that comes with that. And some of it might be institutional buyers who choose to self-insure and, some form of serfdom. So how do we fix it? Collaborative programs make the FAIR plan more competitive, or even partner with private insurance companies to offset some of the risk or to offer tax incentives to help them out there. Micro-insurance products offer small insurance alternatives that are more flexible and more expensive to patch together insurance for people. Legal reform, you can reduce litigation costs and lawsuits, make each party responsible for their own attorney fees so it doesn't turn into endless legal battles, and streamline the approval process for rate increases. And also, climate resilient homes. A lot of people will say it's not the climate, it's the climate. Okay, build homes for the future, not right now. All of these things are expensive, but the cost of the risk is even higher. Once these places become uninsurable, no one can live there. You cannot take a mortgage out on a home that you cannot insure. We have to change our risk models. Risk in general. So there was an entire mess with the BLS payroll revisions that I did a short video on, and revisions are normal. This happens every year and during every presidency, but this revision was massive. I've talked a lot about the issues that we have with economic data over the past couple of years, and I've given a lot of talks about it most recently. And it's becoming increasingly clear that the economic data that we have isn't telling the whole story. It's skewing our risk models. It's a story for another article, another video, but I think we're still using our pre-pandemic frameworks. In a post-pandemic world, you see this happening with the Fed a little bit. It just doesn't work. Like, we have an entirely new economy. We have entirely new people who have been massively changed by a massive event that happened. And we have to rethink how we think about data, how we think about sentiment, how we think about the economy at large, especially with AI companies. So here's a slide from a talk that I gave at the OOO conference last Saturday, hosted by Carrie and Andrew Young. But if you zoom out beyond markets, it seems like the American dream relies on an outdated risk model. The American dream is based on home ownership, and home ownership is extraordinarily risky. Just like insurers have to update, so do we. We have assumed stability of the housing market and jobs and retirement plans, and that just isn't a reality right now. This model update will require us to reevaluate risk across many sectors of the economy. So many things are out of sorts. The data is a tapestry, but no one is responding to surveys. The birth-death model needs to be updated. We have a large segment of the wealthiest people hyper-focused on tax reduction versus building libraries, which is great. And they feel like their money gets lost in bureaucratic red tape. So what does this mean for our future? I really like this paragraph from Sammy Sage. The focus on building generational wealth isn't just about the economy or people's finances, but a collective sense of mutual investment, American prosperity, that we should all have a realistic and slightly more fair chance to share in. It's a return to the idea that if you work hard and play by the rules, you can build a stable future for you and your family. That question is kind of a lottery for people under 40, and people wonder why Gen Z is so nihilistic. Nobody wants to work anymore. That's because they no longer see the potential that working hard will appreciably increase their chances of achieving a financially stable future. I believe lots of people wouldn't mind working harder if they did. Another person pointed out that the defining characteristic of Gen Z is fear. I am a Gen Z as well, and I feel this. You know, you just have a different world than you used to, and risk is in places that it's just never been before. The younger and older generations are terrified of themselves and the world that they live in because the path forward is murky, right? We have immense uncertainty over the next few months, and this leads to financial nihilism in the youth because trust is so expensive. And that's why we see a world divided, because the risk models are all wrong. We're talking about everything wrong. You know, you have the richest people in the world hyper-focused on dividing us further. That's a leadership crisis, right? And then you have what is meant to be a beacon of wealth, housing in the United States, and it's not that. In fact, it's like maybe the riskiest thing that you'll do is buy a home, which I'm being extreme. There's ways to fix this, which is recognizing that things are changing, which is very tough to do. We have to update our risk models specifically for home insurance, but the coasts are eroding, and we have to recognize that. The American state is one of denial, and it just can't be that way anymore. There has to be an acceptance of the fact that the problems we face are big and the solutions need to be even bigger. Risk is manageable with the right hedges. We just have to update our models. You can read this article at kyla.substack.com. It's also in podcast form at Let's Appreciate. I post daily short form videos on TikTok, Instagram, YouTube Shorts, and LinkedIn. And then this YouTube channel would greatly appreciate it if you hit like and subscribe. And if you want, like, that helps the economy, probably. Hope you're doing okay out there, and I'll talk to you very soon.